So today I want to introduce you to the difference between a policy loan and a collateral loan. They're fundamentally different from a tax perspective. It's still a loan at the end of the day, but basically how we treat it from an income tax perspective is quite different. Okay. First of all, a policy loan, of course, is you're taking a loan using the collateral of your insurance policy to the insurance company itself. So if you have $50,000, let's say, and you want to borrow $10,000, $5,000, whatever that number happens to be, you go to the insurance company basically and you apply for a loan at that point. So the actual loan comes from the same insurance company that you happen to have the policy with. Okay. So if you recall in the previous webinar, basically, we discussed what is the policy gain. Remember, so we said that the difference between the adjusted cost base and the actual amount of money that's being withdrawn, that difference, that if there is a gain, that will be taxable. Okay, well, it's the exact same situation for a policy loan. In other words, the difference between the loan amount, whatever you're borrowing, okay, and your ACB will be taxable. So all the things we talked about before in terms of figuring out what is the policy gain. And so we figured out what the ACB was, and then, so in our example, in the previous example, we had $50,000 worth of cash, so sitting in there in your CSV. He had a $15,000 ACB. So let's say he borrowed the entire amount, the entire $50,000. For simplicity's sake, the difference between that $15,000 and the $50,000, basically, that would be considered a loan as well, and therefore it will be taxable. So as you can see, that whether you're actually withdrawing money or whether you're borrowing money, it doesn't really matter. The fact of the matter is, if you are borrowing from an insurance company, so you're using your insurance policy as collateral with an insurance company, and they give you a loan, the difference between the ACB and the actual amount of loan itself will be considered taxable income. Okay, so we go back to our example of Tom here, because something else happens besides the taxation aspect of it and all that. There is something else that goes on as well. So he took a $5,000 loan, let's say, just keeping it again very, very simple. Basically, now the original ACB, before he took the loan out of this example, it was $10,000. Okay, that was the ACB. Now the fact that he did take out a $5,000 loan basically becomes a new ACB, and that new ACB is $5,000. In other words, the loan reduces your ACB. So your loan reduces your ACB. That's really what we are saying here. So you've got two issues here when you're taking a loan from an insurance company. Issue number one is the fact that any gain on that loan will be taxed, just like as if you withdrew the money. So there's no way of getting around that situation, whether it's withdrawal or whether it's a loan. The second part of the equation, of course, is that the ACB changes. And so the actual loan itself will reduce the amount of ACB. So therefore, that means that future taxation, should that policy continue to grow, will be substantially more taxes than everything else. Okay, and so therefore, in this example, Tom took out the $5,000 loan. The original ACB was $10,000. This new ACB now will be $5,000. So if he never pays it back, which we'll talk about in a moment, okay, that will be the new ACB. And so therefore, if the policy continues to grow, particularly, for example, universal lifetime policies where the amount could be substantially more, in that case there could be some more serious tax implications in the future, okay, in terms of a policy loan, okay. The second part of that, however, is what if Tom decides, you know what, I don't want to have to do that. I want to be able to pay it back, okay. So what if I repay my loan? So by repaying a policy loan, he is able to deduct the repayment from the taxable income up to the policy gain itself. In other words, if he puts that money back in, that $5,000 back in, the ACB will again increase. In other words, paying that money, the ACB goes back up again. But also, he can deduct that $5,000, because remember, he would probably have to pay tax on that loan. Okay, he would have to pay tax on the gain, basically. Okay, so by paying back the premium, by paying back all that money and everything else, okay, he can actually take a deduction. So therefore, he's not going to be double taxed, because don't forget that when he pays it back, and then somewhere in the future he's going to borrow again, that means he's got to pay tax on it all over again. That's a double taxation. So what happens basically is that the reality is that the fact that you're paying the money back, you're able to deduct that repayment from your taxable income, from when you're doing your filing, and from your taxable income for that particular year, and up to the policy gain, whatever that gain happened to be, then you can, so you repay the entire amount, you can basically get a tax credit, you might say. So you will get a deduction for that payment. And that is, again, designed to avoid double taxation in the future. The other thing to remember, of course, is the ACB will also increase. So once again, now that your ACB is higher, that means that in the future gain in the future, basically, your tax will not be as onerous as it would be if the ACB was not increased, basically. Then it will be much more onerous. So moral of the story, basically, is that when you're taking out a loan from the insurance company itself, there are taxation issues. That's so there may be some taxation issues here, anything above the ACB. Okay, and second part of that is that if you do repay it back, then you will get a credit back, you might say, because you're able to deduct that repayment, and that increases your ACB for future consideration. Okay, now we're going to be looking at collateral loan in a moment, and so you'll see the difference between a policy loan and a collateral loan.